Welcome to the first video of the course on Advanced Financial Management. This training program consists of 20 modules devoted to the various areas within the interest of a financial officer at a multinational company. More specifically, these topics include the role of a senior financial advisor in a multinational organization, advanced methods of investment appraisal, mergers and acquisitions, corporate reconstruction and reorganization, and finally, treasury management as well as risk management techniques. In this introductory video, we will define the role and key responsibilities of a financial officer at a multinational company. We will also analyze how the activities undertaken by a financial advisor are connected with the strategy of the organization. Finally, we will briefly describe the essential aspects of financial management. The role of a financial manager is among the most important ones in every business organization. This is due to the fact that a financial manager is responsible for managing all of the financial actions of a company, which are aimed at increasing the wealth of shareholders. It is important to note that the decisions made by a financial officer impact numerous areas of a company's activity. These are not only limited to the company's finances, that is its profitability and cash flow generation, but are also closely linked to the fulfillment of regulatory requirements imposed on the company, as well as such issues as the ethical and environmental impact of the company's operations. We will be discussing these additional dimensions of a financial manager's responsibilities in separate modules of the course. To understand the role and functions of the financial manager, it is essential to note that they are in fact anchored in the company's strategy. Typically, in a business organization, the strategy stems from a policy framework that is a document governing the basic corporate decision-making processes, which specifies the criteria in accordance with which strategies are actually created. Clearly, the area of a company's policy framework which defines the roles and responsibilities of a financial manager is the financial policy. Nevertheless, other areas typically included in the policy framework are also linked to financial management. For example, in the area of ethics and social responsibility, which defines the role of the company with regard to its local society and the rules which the company will obey in its relations with individuals and communities. A significant portion of the relevant norms and requirements relate to financial management. Examples of such norms are ensuring fair and honest communication within the company and with its stake and shareholders, guaranteeing that complete and accurate information is disclosed to the markets, as well as compliance with finance-specific laws and regulations. Other roles of the financial manager relate to other areas covered by the policy framework, such as stakeholder protection, where it is the financial manager who is responsible for creation of value for shareholders and lenders. This is accomplished by evaluating investment opportunities and optimizing the firm's cost of capital. Another area, corporate governance, is also linked with the role of the financial manager, who is typically in charge of the company's financial risk management. That process is one of the cornerstones of the governance system in every company. As you can see, financial management, as realized by the financial officer, is associated with each and every one of the strategically important areas of a company's activity. In fact, financial management may be defined as planning the usage and management of a company's financial resources in order to maximize the wealth of the company's shareholders. Accordingly, financial management involves making financial decisions which are aimed at realizing those business objectives which are considered important from a strategic point of view. The list of tasks which typically fall under the responsibility of a financial manager in a corporation is in fact quite long. It encompasses areas such as the selection of investment opportunities, management of financing costs, and pursuit of the company's earnings retention and dividend distribution policy. A financial manager is also responsible for financial budgeting and control, as well as managing financial risks. These responsibilities also include communication with shareholders and creditors. Let us now take a closer look at these areas, starting with investment selection and capital allocation. In light of the fact that the goal of any business is to maximize shareholder value, the need to undertake appropriate investment projects is clearly a critical issue. The selection of investment opportunities is obviously aimed at maximizing the returns achieved on the capital invested, that is, the financial resources provided to the company by shareholders and creditors. The methods applied in this evaluation are predominantly of a quantitative nature, such as discounted cash flow and simulation techniques. You should be aware, however, that investment selection is rarely just about the maximization of financial gains, and that's because creating company value implies much more than just generating earnings. Accordingly, the selection of investment projects requires, among other things, an analysis of the fit of the investment with company values. So prior to undertaking any investment, a company has to assess its ethical and environmental impact, which may potentially be detrimental to the company's reputation and, as a result, have a negative impact on company value in the long term. One of the factors which must be taken into account in the investment selection process is the scarcity of resources and capital, due to which companies are not in a position to finance all of the investments which have a positive outlook. The use of scarce resources has to be rationed so that these are only applied in order to undertake profitable projects that represent the best possible fit with the company's mission and strategy. Raising finance and managing the financing costs of a company is yet another aspect of financial management, and one which is closely linked to the selection of investment opportunities which we just discussed. Obviously, financing is necessary for a firm not only to undertake new investments, but also to facilitate its everyday operations. Managing a company's sources of finance is carried out in the short run with the goal of optimizing the firm's working capital and cash management policies, and in the long run with the goal to equip the company with sufficient and sustainable sources of debt and equity financing. One of the key issues which occupies financial managers in this respect is the optimal level of gearing, that is, to what extent the company should be financed with debt instruments, such as issued bonds and bank loans. The factors which are typically taken into account in deciding on the capital structure of a company are not only the costs associated with the various sources of finance, but also tax issues, risk profile preferences of the company's management and its shareholders, the perception of market analysts, as well as external restrictions such as regulations and debt covenants. A company's distribution and retention policy is yet another essential element of financial management. It is linked to both the policy on investments as well as the optimization of financing costs. The main dilemma faced in the formulation of the distribution and retention policy is whether free cash flows generated by the company should be retained by the business and reinvested or distributed, in other words, paid out to shareholders. The answer to this dilemma depends primarily on the preferences of shareholders, but also on whether the company does indeed have prospective investment opportunities which are worth pursuing. From this angle, the distribution policy should endeavor to answer the question of which of the two possible uses of cash accumulated by the company will best contribute to the creation of company value. Another important area of financial management is the management of financial risk. According to the majority of finance theories, risk is a factor which has a twofold impact on business activity. On the one hand, it may lead to adverse changes in market variables, resulting in a financial loss. On the other hand, it may also be a source of favorable changes, thus generating upside potential. From this perspective, each company has to determine the level of risk it is willing to accept, referred to as its risk appetite. Carrying out the provisions of a risk management policy by the financial manager of a company requires keeping the relevant risk factors such as currency risk, interest rate risk, and credit risk within the limits determined in accordance with the risk appetite of the company. As we will discover in the further modules of the course, effective risk management requires the monitoring and measurement of risk, as well as dealing with risk by means of mitigation, hedging, or diversification. Financial management cannot be effectively conducted without adequate planning and control. These areas of financial management are based on a company's management accounting system, whose principal role is providing management with financial plans and budgets, as well as controlling the company's finances and evaluating its performance. The last of the cornerstones of financial management, which we need to mention in this video, is communication with the company's stakeholders. The goal of such communication is to keep both external stakeholders, such as shareholders, creditors, governments, and customers, as well as internal ones, such as employees and management, informed about the financial condition of the company. Stakeholder communication is effected via different channels, including published financial statements and management reports. Companies listed on stock exchanges are additionally required to submit reports on significant matters and corporate actions taken by the company. Conversely, internal communication is effected by means of reports distributed directly to those groups of stakeholders at which they are aimed. As you can see, the scope of financial management duties which lie within the responsibility of a financial officer is very wide. The general goal of financial management is to ensure that the company's resources are appropriately employed in order to generate value to shareholders and stakeholders of the firm. It can be concluded that any financial decision made by a business organization should conform with the so-called 3E principle. In accordance with this rule, the use of resources has to be economic, meaning that it has to minimize the cost of resources required to achieve a certain business goal. Efficient, that is, ensuring that the business goal has sufficient value in comparison with the cost of the resources employed. And finally, resources have to be spent effectively, that is, in a way which ensures that the use of resources will lead to achieving the assumed objectives. The 3E principle can additionally be supplemented with a fourth component, which is transparency, ensuring that all spending is appropriately recorded, controlled, and reported. In this course, we will be analyzing the various areas of financial management so as to familiarize ourselves with the techniques used by financial managers in the realization of their tasks.